Hey everyone, and welcome back to the Safe, Simple, Sound Podcast Tax Edition. I'm your host, Alex. Thanks for tuning in. Today, we're tackling a topic that's absolutely crucial for anyone approaching or already enjoying retirement: understanding the taxes on your retirement and pension income. It's a complex area, but knowing the rules is key to seizing financial control and ensuring your financial plan is truly sound. Our discussion today is grounded in a detailed guide focused on IRS rules. Think of it as a roadmap for navigating how different retirement income streams are taxed. This guide really breaks down common sources like Social Security, pensions, and various retirement accounts. A couple of things really stand out from this information. First, many people are surprised to learn that their Social Security taxability isn't automatic. It actually depends heavily on your other income. Second, the difference in tax treatment between traditional IRA distributions and Roth IRA distributions is significant, impacting how much spendable cash you actually have. And finally, those required minimum distributions, or RMD rules, are something you absolutely need to be aware of for certain accounts to avoid hefty penalties. Understanding these financial choices is critical for managing your money effectively in retirement. Our goal today is to equip you with the knowledge to confidently handle the retirement income tax landscape, helping you build that essential financial safety net and keep more of your hard-earned money. Ready to get started? Let's jump into our first topic: decoding Social Security income taxation. As retirement income streams start flowing, maybe a pension here, some IRA withdrawals there, it brings up a really important question, one that catches many retirees by surprise. How does all this affect the taxes on your Social Security benefits? That's right, you heard me correctly. For many people, a portion of their Social Security benefits can actually be subject to federal income tax. It's not always the case, but it's crucial to understand when and why it might happen so you can plan accordingly. So today, let's dive in and decode Social Security income taxation. We'll break down how it works, what forms to look for, and how you can manage any potential tax implications. First things first, the key concept you need to grasp is something called provisional income. This isn't a number you'll find pre-printed on any single form. It's a calculation the IRS uses specifically to determine your Social Security taxability. Think of it like mixing ingredients in a bowl. You take half of your annual Social Security benefits, add in all your other taxable income, things like wages from a part-time job, pension payments, withdrawals from traditional IRAs or 401ks, interest, dividends, and you even add in any tax-exempt interest you might have, like from municipal bonds. So just to be crystal clear, it's half your Social Security plus all other taxable income plus tax-exempt interest. That total is your provisional income. It's really important because it looks at your overall financial picture, not just the Social Security check itself. Now, why does this provisional income matter? Because of the key income thresholds for taxability. The IRS sets base amounts depending on your filing status. If you file as single, head of household, qualifying surviving spouse, or married filing separately, and you lived apart from your spouse all year, that base amount is $25,000. If you're married filing jointly, the base amount is $32,000. Here's the deal. If your calculated provisional income is below these thresholds, generally, your Social Security benefits are not taxed at the federal level. Phew! But if your provisional income is above these base amounts, then a portion of your Social Security benefits will be taxable. And depending on how much higher your income is, that taxable portion could be up to 50% or even up to 85% of your benefits. Notice I said up to, it doesn't automatically jump to 85%. There are further calculations, but the critical takeaway is exceeding those thresholds, 25K versus 32K, is what triggers the potential tax. This directly relates back to that idea of combined income streams we talked about earlier. Maybe your Social Security alone wouldn't hit the threshold, but add in a pension and some IRA withdrawals. Suddenly, that provisional income creeps up, potentially pushing your benefits into the taxable range. Something to really think about as you map out your retirement income strategy. Okay, so how do you even know how much Social Security you received, and where does this all go on your tax return? That brings us to reporting your benefits correctly. Every January, you should receive Form SSA 1099, the Social Security Benefit Statement. Keep an eye out for this. Box 5 on this form shows the total net benefits you received during the previous year. When you file your taxes using Form 1040 or the senior-friendly Form 1040 SR, you'll report that total amount from Box 5 on line 6A. Then, after doing the calculation, often using a worksheet in the tax instructions or guided by tax software, referencing IRS Publication 915 for the nitty-gritty details, you'll enter the taxable portion, if any, on line 6B. If none of your benefits are taxable based on your provisional income, you simply enter 0 on line 6B. So let's say you do determine that part of your benefits will be taxable. What now? You don't want a surprise tax bill next April. This is where managing tax payments on benefits comes in. You essentially have two main options. One, voluntary withholding. You can ask the Social Security Administration, SSA, to withhold federal income tax directly from your benefit payments. You do this by filling out Form W-4V, Voluntary Withholding Request, and sending it to the SSA. You can choose to have 7%, 10%, 12%, or 22% withheld. This can be a simple way to handle the tax liability throughout the year, a classic set-it-and-forget-it approach to tax withholding retirement income. Number 2, estimated tax payments. If you prefer not to have taxes withheld from your benefits, or if the withholding isn't enough to cover your total tax liability, remember other income sources. You might need to make quarterly estimated tax payments directly to the IRS throughout the year. This really gets to that proactive planning question. What steps can you take before year-end? Well, estimating your provisional income now is key. If it looks like you'll exceed the threshold, you can decide now whether to submit a Form W-4V for withholding starting soon or budget for making those quarterly estimated payments. Don't wait until next tax season. So, take a moment and think about your situation. What are all your potential income sources in retirement? How might they add up when you calculate that provisional income? Being aware of this calculation is the first step towards managing your Social Security taxability effectively. Let's quickly recap the key takeaways. Whether your Social Security is taxed depends on your provisional income, half your SS plus other taxable income plus tax-exempt interest. Know the thresholds: $25,000 for most single filers, $32,000 for married filing jointly. Exceeding these means a portion of your benefits up to 85% could be taxable. Look for Form SSA 1099 in January. Report the total on line 6A of your 1040, 1040 SR, and the calculated taxable amount on line 6B. Manage potential taxes proactively through voluntary withholding Form W-4V or estimated tax payments. Now, here's your call to action for this segment. Sometime this week, try to estimate your provisional income for the current year. Grab your latest Social Security statement estimate. Think about your expected pensions, wages, interest, dividends, IRA withdrawals, etc. You can find worksheets and detailed guidance in IRS Publication 915, Social Security and Equivalent Railroad Retirement Benefits. Doing this rough calculation now can give you valuable insight and help you anticipate whether your benefits might be taxable, avoiding any unwelcome surprises come tax time. In our last segment, we unpacked the sometimes surprising ways Social Security benefits can be taxed based on your overall income picture. But as many of you know, Social Security is often just one stream feeding into your retirement reservoir. Many retirees also rely on income from pensions, annuities, or withdrawals from traditional retirement accounts like IRAs. So, how does the taxman view those dollars? That's exactly what we're tackling next. Navigating taxes on pensions, annuities, and traditional IRA distributions. Think of it like this. You spent years diligently saving and contributing to these accounts, often getting a tax break up front. Now, as you start drawing that money out in retirement, it's generally time for the IRS to get its share. Don't worry, though. Understanding the rules makes it much less daunting. So let's start with the general rule. For the most part, payments you receive from pensions, annuities, and traditional IRA distributions are considered taxable income in the year you actually get the money. It's just like earning a wage, but for retirees. The key document here is Form 1099-R. Your plan custodian or payer sends this form out early in the year, detailing how much you received. You'll typically report these amounts on your Form 1040 or 1040 SR, usually on lines 5A for the total distribution and 5B for the taxable portion. Keep an eye out for that 1099-R. It's your roadmap for reporting this income. Now, let's touch on a few specific income sources that fall under this umbrella. Common employer pensions? Yep, generally taxable. Military retirement pay tax rules? If your military retirement is based on age or length of service, it's treated like a regular pension and is taxable pension income tax. What about disability pensions? If you retire on disability and the plan was paid for by your employer, those payments are generally taxable too. There's a slight reporting difference, though. You might report it as wages on line 1H of Form 1040 until you reach minimum retirement age, and then it shifts to being reported as pension income on lines 5A and 5B. Just a little detail to be aware of depending on your age. We should also briefly mention annuity income tax generally follows similar principles. Payments are typically taxable. A big one for many people is traditional IRA distributions. Remember, saving in that traditional IRA, maybe getting a tax deduction for your contributions along the way? Well, when you take money out, whether it's your original contributions that were deductible or the earnings that grew over time, it's generally taxed as ordinary income. Again, Form 1099-R is crucial here. It will show the total amount withdrawn and usually indicates the taxable amount, making your IRA distribution tax reporting much clearer. Okay, are there exceptions and special cases? Absolutely. Tax rules wouldn't be tax rules without them. One key exception involves non-deductible contributions to a traditional IRA. Maybe you contributed some years, but weren't eligible to deduct it. That money was already taxed before it went in, so when you withdraw it, you don't pay tax on it again. This non-taxable portion is called your basis. The catch? You need to keep track of this basis over the years, usually using Form 8606. This is a prime example of why good record keeping is essential. So thinking about the non-deductible IRA contributions tax treatment, it means not all of your withdrawal might be taxable if you track this properly. Another thing to watch out for is the potential 10% additional tax on traditional IRA withdrawal before 59.5. If you tap into your traditional IRA before reaching age 59.5, you might face this extra penalty on the taxable portion on top of the regular income tax. Think of it as a fee for accessing the funds early. Now, there are exceptions to this penalty, like using the money for certain medical expenses or if you become disabled, but the general rule is to be cautious about early withdrawals. Finally, let's touch on tax-free rollovers. This is a really helpful tool. If you take a distribution from, say, a traditional IRA, but then you roll over those funds into another eligible retirement account, like another traditional IRA or maybe a 401k within 60 days, it's generally not a taxable event right then. It's like moving your retirement savings from one qualified pocket to another without triggering immediate taxes. Just be sure to follow the rules carefully, especially that 60-day deadline. Okay, let's pause and reflect for a moment. Think about the retirement income tax implications we just covered. When you look at that Form 1099-R you get for a pension or IRA distribution, what are you zeroing in on? It's usually Box 1, the gross distribution, and critically Box 2A, the taxable amount. Sometimes Box 2A might be blank or say unknown, which means you need to figure out the taxable part. This often happens if you have that non-deductible basis we talked about. And that leads to the second reflection point. If you did make those non-deductible contributions to your traditional IRA in the past, how does that change the game for your current or future withdrawals? It means part of each withdrawal could be tax-free, but only if you've tracked it correctly using Form 8606. So to wrap up this segment on pensions, annuities, and traditional IRAs, key takeaway 1, assume distributions are taxable income unless proven otherwise. Key takeaway 2, your guide is Form 1099-R. Understand what it's telling you. Key takeaway 3, for traditional IRAs, both deductible contributions and earnings are generally taxed upon withdrawal. Key takeaway 4, watch out for the early withdrawal penalty if you're under 59.5, but remember, non-deductible contributions basis aren't taxed again. Key takeaway 5. Rollovers done correctly within 60 days can defer taxes. Now for your call to action. When you get a chance, pull out your most recent Form 1099-R statements for any pension, annuity, or traditional IRA distributions you received. Take a close look at Box 1, Gross Distribution, and Box 2A, Taxable Amount. Does the taxable amount make sense based on what we discussed? Understanding these numbers is the first step to confidently managing your retirement income tax obligations. All right, so we've just unpacked the often complex tax rules surrounding income from pensions, annuities, and especially those traditional IRA distributions, where typically the tax bill comes due when you take the money out. But now, let's shift gears and talk about a retirement account that flips that script. One that often gets people really excited precisely because of its tax treatment in retirement, the Roth IRA. Today, we're diving deep into Roth IRA distribution rules. The big headline you always hear is tax-free withdrawals, right? And that potential is incredibly powerful for retirement planning. But like anything involving taxes, the devil is in the details. So our goal here is to understand exactly what makes a Roth withdrawal tax-free and what happens if it doesn't meet the criteria. First off, let's hit that main attraction, the primary benefit, tax-free growth and withdrawals. This is the core appeal. When you take a qualified distribution from your Roth IRA, not only are your original contributions tax-free because you made them with after-tax money, but all the earnings, all that growth over the years also comes out completely free from federal income tax. Think about that for a second, a stream of income in retirement that Uncle Sam doesn't touch. That's huge. But notice I keep emphasizing the word qualified. That's the magic word here. So, what makes a distribution qualified? It's not automatic. There are two crucial tests you must pass. 1, the 5-year holding period. You need to have held a Roth IRA, any Roth IRA, for at least 5 years. This clock starts ticking on January 1st of the year you made your very first contribution to any Roth IRA. So if your first ever Roth contribution was in, say, June 2020, your 5-year waiting period is met starting January 1st, 2025. It's like aging a fine cheese. You need that time. 2, a qualifying event. On top of the 5-year rule, the withdrawal must be for a specific reason. The most common one is simply reaching age 59.5. Other qualifying events include becoming totally and permanently disabled, the distribution being made to your beneficiary after your death, or using up to $10,000 lifetime limit for a first-time home purchase. Meet both those conditions, the 5-year wait and a qualifying event, and boom, your Roth IRA distribution is gloriously tax-free. Now, this leads to a really important planning point. Take a moment and reflect. How does the potential for tax-free withdrawals from a Roth IRA influence your retirement income planning? How might you think differently about pulling money from your Roth compared to taxable sources like a traditional IRA or a regular brokerage account, especially when trying to manage your overall tax bracket in retirement? It really adds another strategic layer, doesn't it? Okay, but what happens if you need your Roth money before meeting both those qualified distribution tests? Maybe you're under 59.5, or you haven't hit that 5-year mark yet. This is where we talk about taxation of non-qualified distributions. The IRS has specific ordering rules for how money comes out of a Roth IRA in a non-qualified situation. Think of it like layers in a cake. First layer out, your direct contributions. The good news? Since you put this money in after tax, you can always pull your contributions out tax-free and penalty-free anytime for any reason. It's like getting your initial investment back. Second layer out, any money you converted from a traditional IRA or rolled over. The tax treatment here can depend on the specifics of the conversion, but generally, the converted principal comes out tax-free since you likely paid tax at conversion, though earnings within the conversion might be different, and there can be separate 5-year rules related to penalties on conversions. We won't dive too deep into conversions today, but know they're the next layer. Third and final layer out, the earnings. This is the last money to come out. If your distribution isn't qualified, this is the portion that might be subject to ordinary income tax. And if you're under age 59.5 when you take out these earnings, you could also face that familiar 10% early withdrawal penalty, unless an exception applies. This brings up another point for reflection. Considering the 5-year rule and those qualifying events, what kind of real-life scenarios, maybe an unexpected job loss or a major health expense before age 59 and a half, might lead you to take a non-qualified and potentially taxable distribution from your Roth IRA? It's worth thinking through potential needs. Now, a quick note on paperwork. Even if your Roth distribution is completely tax-free and qualified, you'll still receive a Form 1099-R from your custodian. Don't panic when you see it. This form reports the distribution to the IRS. The codes in Box 7 are key. They tell the IRS why the distribution was made and help determine its tax treatment. So understanding that reporting Roth distributions happens, even when no tax is due, is important for accurate filing. It helps differentiate it from a taxable IRA distribution tax situation you might see with a traditional IRA. Finally, let's highlight a key distinction that makes Roth IRAs particularly attractive for long-term planning and estate planning. No lifetime RMDs. Unlike traditional IRAs, where you generally must start taking required minimum distributions, or RMDs, starting at age 73, the original owner of a Roth IRA is never forced to take distributions during their lifetime. This means your Roth money can potentially keep growing tax-free for longer, and you have complete control over when or even if you tap into it. This is a significant advantage compared to the mandatory RMD rules for traditional accounts. So, let's quickly recap the essentials of Roth IRA distributions. The big win: qualified distributions are completely tax-free. Qualified means meeting both the 5-year holding period starting from your first contribution to any Roth and having a qualifying event like reaching age 59 and a half. If a distribution isn't qualified, your contributions come out first, always tax/penalty free, then conversions, then potentially taxable earnings, which might also have a 10% penalty if you're under 59 and a half. Expect a Form 1099-R even for tax-free withdrawals. The codes matter. And a major perk: no lifetime required minimum distributions for the original owner. Now, for your action item from this segment. It's crucial for understanding your own situation. If you have a Roth IRA, make it a point to verify the date, or at least the year, of your very first contribution. Dig through old statements if you have to. Knowing when that 5-year clock officially started is fundamental to planning when you can access those powerful tax-free qualified distributions. We explored the beauty of Roth IRA distributions, particularly how qualified distributions can be tax-free, and how, as the original owner, you're not forced to take money out during your lifetime. It's a fantastic feature. But speaking of not having to take money out, that brings us neatly to our next important topic: situations where you are required to start withdrawing funds. We're talking about required minimum distributions, or RMDs. Now, I know required minimum distribution sounds a bit official, maybe even a little intimidating, but stick with me. Understanding the RMD rules is absolutely crucial for managing your retirement income effectively and avoiding some pretty hefty penalties. Think of this segment as your RMD demystifier. We'll break it down into simple, manageable pieces. So, first things first. What exactly are RMDs? At its core, an RMD is a mandatory withdrawal the IRS requires you to take each year from certain types of retirement accounts once you hit a specific age. Why? Well, think about accounts like traditional IRAs or 401ks. You likely got a tax deduction when you put money in, and the money grew tax-deferred for years, maybe decades. The government essentially says, okay, that tax break was great, but eventually we need to collect the income tax owed on that money. RMDs are the mechanism to ensure that happens systematically during your retirement years. It forces those traditional IRA distributions and other plan withdrawals to start happening so they can be taxed. Second, which accounts are we talking about? This is key. RMDs generally apply to tax-deferred retirement accounts. We're looking at traditional IRAs, SEP IRAs, simple IRAs, 401k plans, 403b plans, 457b plans, and other profit-sharing or employer-sponsored defined contribution plans. Now remember what we just talked about? The big exception here, and a crucial point highlighting the tax difference between Roth and traditional IRAs, is the Roth IRA. If you are the original owner of a Roth IRA, you are not required to take RMDs from it during your lifetime. Your beneficiaries will have rules to follow, but not you. That's a significant planning advantage for Roths and impacts Roth IRA distribution rules. Third point, when do these RMDs start and what are the deadlines? This has changed a bit over the years, so it's important to know the current rule. Generally, you must start taking RMDs for the year you turn age 73. Now, there's a little grace period for your very first RMD. You have until April 1st of the year following the year you turn 73 to take that initial distribution. Let's make that real. Say you turn 73 in August 2024. Your first RMD is technically for the year 2024, but you have until April 1st, 2025 to actually withdraw it. But, and this is important, for every subsequent year after that first one, the deadline is December 31st. So using our example, your RMD for the year 2025 would need to be taken out by December 31st, 2025. If you delay that first RMD until the following April, you'll actually end up taking 2 RMDs in that calendar year, the one for the year you turned 73 and the one for the current year. That could potentially bump you into a higher tax bracket, so it's something to plan for. This directly answers that common question, when do I have to take RMDs from my IRA? Generally, starting the year you turn 73, with that specific first-year deadline nuance. Fourth, how are RMDs taxed, and how is the amount calculated? Generally, the amount you withdraw as an RMD from a tax-deferred account like those traditional IRAs or 401ks is treated as taxable ordinary income for that year. It gets added to your other income like pensions or Social Security, potentially impacting the overall taxes for retirees. This is a critical part of tax filing for seniors retirees, knowing how this IRA distribution tax works. Now, calculating the exact RMD amount involves your account balance at the end of the previous year and an IRS life expectancy factor. The good news? You usually don't have to crunch these numbers yourself unless you want to double check. Your IRA custodian or plan administrator is typically required to calculate this for you, or at least offer to calculate it. You'll often see it reported on your year-end statements or in a separate notice early in the year the RMD is due. And finally, point number 5. Why is this so important? The cost of getting it wrong. Folks, this is where you really need to pay attention. Failing to take your full RMD by the deadline comes with one of the steepest penalties the IRS levies. Currently, the penalty is 25% of the amount you should have withdrawn but didn't. Ouch, that's a huge bite. There's a provision where this penalty might be reduced to 10% if you correct the shortfall quickly and file the right form. But honestly, the best strategy is simply to avoid the penalty altogether by taking your RMD on time every year. So hearing all this probably sparks some thoughts. How do these mandatory RMD rules influence how you might think about managing your assets as you approach and move past age 73? For instance, does it make you consider drawing down traditional accounts first, preserving the non-RMD Roth accounts for later? It's a common strategy. And practically speaking, what systems can you put in place to make sure you don't miss this? Maybe setting calendar reminders well before December 31st, confirming with your custodians early in the year that they'll notify you of the amount. Perhaps consolidating older, smaller accounts to simplify tracking. These proactive steps are key. Okay, let's quickly recap the essentials of mastering RMDs. They are required minimum distributions, mandatory annual withdrawals. They apply mainly to tax-deferred accounts like traditional IRAs and 401ks, starting generally at age 73. Roth IRAs are exempt for owners. Know your deadlines. April 1st of the year after you turn 73 for the first one, then December 31st each year after. The withdrawal is typically taxed as ordinary income. Missing the deadline carries a significant penalty, currently 25% of the shortfall. Your homework from this segment, your call to action, is straightforward but vital. Take a moment soon to identify all your retirement accounts that are subject to RMDs. Then, based on your birth date, confirm the year you turn 73. That's your RMD starting year. Knowing this information is the first step to confidently managing your RMDs. Getting a handle on RMDs is a crucial step in navigating your retirement finances smoothly and keeping more of your hard-earned money working for you, not going towards penalties. And just like that, we've covered a lot of ground on navigating the often tricky world of retirement income tax. Our goal today was to break down these complex rules to help you keep things simple and ensure your financial planning is sound. We started by decoding Social Security taxability. Remember, it often depends heavily on your other income, so understanding your provisional income and Form SSA 1099 is crucial. Then we navigated the landscape of pension income tax and traditional IRA distributions, highlighting the importance of Form 1099-R and the general rule that these are usually taxable. We contrasted that with the unique Roth IRA distribution rules, explaining how qualified withdrawals can be tax-free, a powerful planning tool. And finally, we tackled those critical RMD rules, emphasizing which accounts they apply to and the importance of taking them on time to avoid penalties. I think two particularly impactful points are realizing that Social Security taxability isn't a given and can be influenced by your other retirement withdrawals, and just how vital it is to stay compliant with the RMD rules as you approach and pass age 73. Understanding these nuances truly is key to managing taxes for retirees effectively. Getting a handle on your IRA distribution tax implications, whether traditional or Roth, and knowing how your pension fits in helps you build that financial safety net and maintain financial control throughout your retirement years. Thank you so much for tuning in and spending your valuable time with me today on the Safe, Simple, Sound podcast. I really appreciate you being part of our community. For links to the IRS resources we mentioned, like Publication 915 for Social Security and Publication 575 for pensions, plus a recap of today's key takeaways, please check out the show notes on our website. And perhaps use this information to think about managing your tax withholding retirement income needs for the rest of the year. If you found this episode helpful, please consider subscribing so you don't miss future episodes. Leaving a review or sharing this discussion with a friend or family member navigating their own retirement income questions would also be fantastic. Remember, understanding your finances, especially retirement income tax, empowers you to make informed decisions. Keep learning, stay proactive, and continue making those sound financial choices. This is Alex, reminding you to keep it safe, simple, and sound. Until next time.